So IFRS 16 is a very important standard for the F7 exam because we can see this standard within the objective test case question as well as the final account question. And when we say the final account question, it is a question which you are required to prepare the financial statement. The trial balance is given alongside the adjustments. So you may see this standard over there or within the adjustments. Now, the first thing you need to understand regarding IFRS 16 is the background. Previously, we used to call this standard as IAS 17. And we are going to talk about the accounting for lessee. Accounting for lessee. And like when we talk about the lease is a relationship between two parties. One is the lessor who is actually giving the right of use to the lessee, and one is the lessee who's receiving the right of use asset. So there are two parties involved within the lease. One is the lessor and the other is the lessee. You may pronounce it differently, but I usually call it as the lessor and the lessee. So when we talk about the IAS 17, the accounting for lessee was different. And now we have a completely different treatment within IFRS 16 for the lessee. Why there was a need to change the standard, why they changed the standard, why there is a new treatment. There's a background of that, and I'm going to explain that. And I'm talking from the lessee perspective. As I said, in the F7, we are particularly talking about the accounting for lessee. So in the IAS 17, there was a debate that which lease it is. There were two types of leases, finance lease and the operating lease. In the finance lease, the lessee used to record the asset, leased asset. The lessee used to record the leased asset. The asset they were taking on the lease was recorded by the lessee as the leased asset. In the operating lease, the lessee was not recording any asset, so no asset was being recorded. And the lessee used to record the lease payments as rental. So there were two types of leases. There were two types of leases, the finance lease and the operating lease. In the finance lease, the lessee used to record the leased asset. The asset they were taking on the lease were recorded as the leased asset. In the operating lease, if they were not recording any asset or assets, and they were recording the lease payments as the rental. Rental means rental expense. Now, how they were realizing that whether this is a finance lease or operating lease, there were certain factors based on which the lessee used to decide whether it was a finance lease or an operating lease. Let me give you some examples of that. For example, the lease payments they are making, if you calculate the present value of those lease payments, present value of lease payments, and it is approximately equal to the fair value of the asset, then the lessee used to record the leased asset. How come? What is the reason behind it? Was the logic behind that? The logic is simply that obviously when you're getting an asset on the lease, you will be making the payment for a certain number of years. And if you calculate the present value of all those lease payments, for example, you're taking an asset on 5-year lease, and if you calculate the present value of all those lease payments, and that present value is approximately equal to the fair value of the asset. The fair value means the market value of the asset now. So if the present value equals to the fair value of the asset, that means lessee is basically paying for the complete asset. So the lessee used to record the lease asset because they are paying, in fact, for the full asset. Similarly, if the asset was purpose-built asset, that means that was specially made for the lessee and there was no other use. So it is a purpose-built asset, specialized asset for the lessee only. So that means there is no other use and the asset used to be recorded by the lessee. The other factor was the lease is for the major part of asset life. Like for example, the total life of the asset is, let's assume 7 years. And the lessee has leased the asset for 5 years. That means majorly it will be used by the lessee. So the major life it is being used by the lessee. So the lessee used to record that asset as the leased asset. There were other factors as well. For example, the asset will be transferred to the lessee by the end of the lease period and etc. etc. So I've given you a few examples of that. So based on these factors, that the present value of the lease payment is approximately equal to the fair value of the asset. Asset is the purpose-built asset. Lease is for the major part of asset life. Asset will be transferred to the lessee by the end of the lease payment at the substantially low rates, etc., etc. So all of these factors suggest that this asset belongs to the lessee because they are making almost full payment of it. Asset is specially made for the lessee. They're using it for the major part of the asset life. So common sense prevails. This asset should be recorded by the lessee. Other than that, if it is not a finance lease, it should be recorded as an operating lease within IS 17 I'm talking about. So within operating lease, lessee were not recording any asset. And in fact, all those lease payments were recorded as the rentals. So here, the asset, here, no asset, and just the rentals. Now, the treatment seems to be appropriate. And in fact, it was appropriate for many years. We were following this. So it used to be an appropriate treatment unless we realized that there is a major flaw within this treatment. What is that flaw? What is that problem? The problem is that the common factor between these two leases are, in both of the leases, whether it is a finance lease or an operating lease. So let's just write these things. The common things within these two different types of lease, the common factors. In both of the leases, whether it is a finance lease or an operating lease, in both of the leases, the lessee is getting the asset. The asset is involved. Even with the finance lease, the lessee is getting the asset. Even within the operating lease, the lessee is getting the asset. And the second point, the common point, in both of the leases, whether it is a finance lease or an operating lease, the economic benefits within the lease period, the economic benefits within the lease periods were being enjoyed by the lessee. So whether it's a finance lease, lessee is going to use the asset and all the benefit belongs to the lessee. Even if in the operating lease, the lessee is using the asset, the economic benefit belongs to the lessee. So asset is involved in both of the leases. Economic benefit, then control within that lease period. Lessee used to decide how they will be using it. Like for example, if it is a finance lease, even within the finance lease, the lessee used to decide how they will be using the asset. For example, if it's a machine, how many hours they will be using the machine, how many days within a week they will be using the machine, etc. So how many units they will be producing from the machine, etc., etc. Even within the operating lease, the lessee used to decide within the lease period how the asset will be used. So if you talk about the risk and rewards within that lease period, the risk and rewards belongs to the lessee. So there is the evidence of economic benefits. There is an evidence of the control and the cost. Yes, you can measure the cost of the lease because you are making payment for it. So when you see all these factors, that there's a resource involved, which is an asset, and that resource is producing the economic benefit, and that resource is being controlled by the lessee within the lease period, and even you can measure the cost of that lease. So after looking at these points, we can clearly see that the definition of the asset is being met. The definition of the asset is being met because the asset definition says that an asset is a resource which is controlled by the entity from which future economic benefits are probable that will flow to the entity. There's a control and the cost can be reliably measured. So all of the criteria is being met. So when you are classifying operating lease as a rental and there's no involvement of the asset, then that means this treatment of the lease does not comply with the financial reporting framework definition of the asset. Because in both of the leases, the asset is involved. In both of the leases, economic benefit will flow to the lessee. In both of the lease, the control during the lease period belongs to the lessee. You can measure the cost of the lease payment as well. So that means the definition of the asset is being met. Why you are recording the rental within the operating lease. So that means this treatment later on they realize is not consistent with the definition of the asset and liability within the framework. So this treatment is now discontinued. You are not going to follow this treatment anymore. It is being from 2016 basically. So you are not going to follow this treatment. And in fact, now you are having a completely new treatment within the IFRS 16. So this is the problem. I have written it clearly that the operating lease in which you were not recording any asset. In fact, you were recording it as a rental arrangement expense. It does not meet the criteria, the definition of the asset and liability within the conceptual framework. So this treatment is no longer applicable. And now we have a completely new treatment. So now coming towards the definitions, a lease is a contract or a part of the contract that conveys the right to use an underlying asset for a period of time in exchange for the consideration. So lease is a contract or a part of contract in which that conveys the right to use an underlying asset. When you say underlying asset, that means those assets or those assets which are being involved within a lease contract. So the right to use that asset is being transferred from one party to another in exchange for the consideration. So the party who is giving the right to use the asset is known as the lessor, and they will be receiving the payments. The party who is getting the right to use the asset is the lessee, and they will be making the lease payments. When we say right to use or right of use asset, is the lessee's right to use an underlying asset over the lease term. For example, I'm leasing a machine for a period of 5 years. So that means I'm getting a right to use that machine for a period of 5 years. Right of use asset means right to use that asset. So these are the definitions. So remember the background, that the background is that IS 17 treatment is no longer applicable because that was not consistent with the definition of the asset and liability within the financial reporting framework. So now we have a different treatment, which says that you are going to record a contract as a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for the consideration. Now, concentrate on this definition. There are two factors, two main things within this definition. The first thing is the identified asset. Identified asset means that the asset or assets which you are talking about within the lease contract should be specifically mentioned within the lease. For example, if I'm leasing cars, those cars should be specifically mentioned within the lease. For example, which color it is, which model it is, what registration number the car are having, etc., etc. For example, if I am leasing machines, those machines should be specifically mentioned within the contract. Identified asset. And the lessor is not going to change those assets unless and until required. Now, the exception may exist because, for example, if you lease 5 cars, let's assume, and one of them is not working, so obviously within the contract, there will be a clause that if any asset is not working, the lessor will be responsible to replace it and to give a similar asset in exchange. Other than that, lessor will not be having any right to get involved within those assets in the lease period. So identified asset means the asset should be specifically mentioned within the contract. The second element is right to control, that it is going to be the lessee who will be deciding how they will be using the asset. That simply means right to direct the identified asset use. The lessee will decide how to use it, when to use it, and there should be no involvement of the lessor within that. And all the economic benefits pertaining to the lease period should belong to the lessee. If there is any involvement within the economic benefits produced by the asset within the lease period, then that means this is not a lease contract. So in order to classify a contract as a lease, first of all, there should be an identified asset. That means the asset or assets should be specifically mentioned within the contract. And the second thing is the right to control. Right to control means all the economic benefits belongs to the lessee, and the lessee has the right to direct the use of the identified asset. Lessee will decide how the asset will be used. Remember, if these 2 points are not present, that means either if there's no identified asset or there's no right to control, then it is going to be a contract for service rather than a lease contract. Let me give you an example and then you can clearly understand what I meant over here. So under a contract between a local government, L, and a private sector, P provides L 20 trucks to be used for refuse collection on behalf of L for a 6-year period. So L is basically a local government authority. They are leasing 20 trucks from P, which is a private sector, for a 6-year period, which is the lease period. The trucks which are owned by P, that means legal form belongs to P. And remember this thing, we have already discussed it several times, that in accounting, we do not look at the legal forms. We work on the substance over form. And the substance over form concept states that we always see the commercial substance rather than the legal forms. So the substance over form, you have already studied it in your earlier accounting paper, that this is a concept which states that you always see the commercial substance or economic reality, commercial substance rather than legal forms. So the 20 trucks which are owned by P, so the legal title belongs to P, but we are not concerned with that. The 20 trucks are specified in the contract. So that means it's an identified asset, because I told you that in order to classify a contract as a lease contract, there should be 2 things within it. The first thing is the identified asset. That means the asset or assets should be specifically mentioned within the contract. And the right to control, that means the lessee is going to decide how to use it, and the economic benefits belongs to the lessee. So L determines how they are used in the refuse collection process. Now the lessee, which is L, they are deciding how to use the trucks. When the trucks are not in use, they are kept at the L premises. Even they are not using it, still they will be holding those trucks. L can use the trucks for another purposes if it chooses. That means if they want to use it other way, they can do that, because all the economic benefits belong to the lessee. So all the economic benefits belong to the lessee, and the lessee is directing the use of the identified asset. So the criteria is met. There is an evidence of the identified asset because the trucks are specified within the contract, and the lessee can direct the use of the identified asset because they can use it according to their own wish, and they can use it other than the refuse collection as well. If a particular truck needs to be serviced or repaired, P is required to substitute a truck of the same type. Otherwise, and other than on default by L, P cannot retrieve the trucks during the 6-year period. If, for example, if there is a problem, they're going to replace the truck. Otherwise, it is going to be the same trucks for the 6-year period. So is it a lease contract? Yes, this is a lease contract because there is evidence of the identified asset. and the lessee is deciding how to direct the use of those trucks, and all the economic benefits can be seen belongs to the lessee. Now, if I change this scenario for a moment, that means the P is saying, okay, whenever you want to collect whenever you want to do the refuse collection, you just tell us, and or trucks will be coming, and we will be collecting the refuse. We will be doing the refuse collection. And they're not giving the control of the trucks to the lessee, the local government authority. They're saying, we will be doing the refuse collection on behalf of you. Just give us the time, or trucks will be coming up on that time. We will do the refuse collection and then we'll go. The trucks will be kept at our own premises, and you cannot use the trucks other than the refuse collection. So in that case, it's a contract for service rather than a lease contract, because they're just providing you the service of the refuse collection. The trucks will be coming up for a particular task, and then it is going to be kept at the at the lessor's premises. So that means it is not going to be a lease contract. It's a contract for service. You're paying them for a particular task, and that service should be recorded as an expense. There is no evidence of the lease. But if it is a lease contract, then the lessee is going to record the right of use asset, debit right of use asset, and credit lease obligations. That means this is the liability for making the lease payments for 6 years. This is the total value of the liability, which is the present value of the lease payments. We're going to study that in a while. So if it is a lease contract, the lessee will be recording right of use asset. If it is a contract for service rather than a lease contract, then you're going to record that service as an expense rather than an asset. All right, now we have another example. The customer C enters into a contract with the road haulier for the transportation of the goods from London to Edinburgh on a specified truck. The truck is explicitly specified in the contract, and H does not have the substitution rights. So customer C is entering into a contract with the road haulier for the transportation of goods. The truck is specified within the contract. That means it is an identified asset because it is specifically mentioned within the contract. The goods will occupy substantially all of the capacity of the truck. The contract specifies the goods to be transported. That means you can only take those goods on the truck, and dates of pickup and the delivery as well. That means the certain time period is mentioned at this time, these goods will be picked up and delivered at a certain place. H operates and maintains the truck and is responsible for the safe delivery of the goods. C is prohibited from hiring another haulier to transport the goods or operating the truck itself. So is this a lease contract or a contract for service? So yes, it's a contract for service. The reason is that although the asset is identified, that means specifically mentioned within the contract, but the goods are being specified. The goods are being specified that, okay, you can only take those goods on the truck and at the particular dates and the particular time. So that means it's basically a contract for service. That means they're giving them the cargo service, the pick and drop service, rather than leasing a truck itself. Because if it is a truck itself, you can use it at any time. You can use it to take any sort of goods. So if the goods are being mentioned, even the time and the dates are being mentioned, so that means it's a contract for service. So this should be recorded as an expense rather than as an asset. All right, now we have another example. AFG enters into a contract with Splash, the supplier to use a specified ship for 5-year period. So again, a specified ship is there. So that means it's an identified asset. Splash has no substitution right. This gives even more evidence of the identified asset. During the contract period, AFG decides what cargo will be transported, when the ship will sail, and which ports it will sail. So the time, the goods, and the place is decided by the lessee, because AFG is the one who is getting the asset. So AFG is the lessee, Splash is the lessor. So lessee this is deciding. However, there are some restrictions specified in the contract. Those restrictions prevent AFG from carrying hazardous materials as cargo, from sailing the ship into waters where piracy is. So there are two restrictions: carrying up the hazardous material and from sailing the ship into waters where piracy is the risk. Splash operate and maintain the ship and is responsible for the safe passage of the cargo. AFG is prohibited from hiring another operator for the ship and from operating the ship itself during the term of the contract. So the requirement is, does the contract contain a lease? So if it is a lease contract, then the lessee would be recording that as a right of use asset. And if it is not a lease, then it's a contract for service, which should be recorded as an expense. So what do you think it is? So it's a lease contract. It's not a contract for service. Why it is a lease contract? Because the asset is the identified asset. It is being specifically mentioned within the contract. The ship is being specifically mentioned within the contract, and there are no substitution rights. So identified asset point is met. Now we need to see right to control. Who is deciding which goods to be transported? What cargo to be transported? AFG. When the ship will sail, who is deciding? AFG. Which ports it will sail? AFG. So right to direct the use of the identified asset, the lessee is deciding. All the economic benefits belongs to the lessee. So that means right to control the thing is being met as well. So identified asset point met. Right to control met. So that means it's a lease contract rather than a contract for service. Now the points which are mentioned within the second paragraph, that AFG is prohibited from hiring another operator for the ship, because ship is not a joke. Like obviously it's a big asset and not everyone has the competence to operate it. So they need to make sure that someone who has the competence is operating the ship. So they're said they cannot hire any other operator and they cannot even operate the ship itself. So they are not placing any limitations on their economic benefits. They are not saying that we are not going to take your goods, we are going to take certain goods, we will not be going on certain places. They are saying we will go everywhere except for the places where piracy is a risk. We will carry everything except for the hazardous material, because anyone is not going to carry that because that is hazardous. Obviously, it can cause severe damage to the ship. So that is the common sense based thing, that obviously no one is going to carry the hazardous material. No one is going to operate the ship in the waters where piracy is a risk. They're not stopping you to take any sort of goods other than the hazardous material. You can take anything and you can go anywhere and you can take the ship anytime. They are acting as an operator that does not restrict your control, because that is a technical thing. Not everyone can operate the ship. So it's actually a lease contract rather than a contract for service. So many students usually get trouble within this example. But anyways, it's a lease contract rather than a contract for service. The usage does not place any limitation that if they're operating the ship themselves, that it does not cause any restriction to the use. That is why it's a lease contract rather than a contract for service. All right, so we have the solution here as well. You can read it by yourself. And now we have the lease term. What is lease term? Lease term is the non-cancelable period for which a lessee has the right to use an underlying asset. No, it's simply a lease period. Lease term means lease period. So lease term is a non-cancelable lease period. Together with periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. Let's assume the non-cancelable period is 5 years. Non-cancelable period is 5 years, and then the lessee can continue for another 2 years. Lessee can continue the lease for another 2 years. Now, the first scenario is the lessee is unsure whether they will be availing the option of those 2 years. So in that case, they are going to take the lease period as 5 years. So if they're unsure whether they will be availing that extendable lease period, then they are going to take only 5 years. The second scenario is they are reasonably certain. That means it is highly likely, there's a high level confidence that they will be availing only one further year. So in the first scenario, I said they will be, they're unsure whether they will be availing the extendable period. So in that case, the lease period is 5 years. In the second scenario, I told you that they are reasonably certain, it is highly likely that they will be taking a 1 year extension. In that case, the lease period is going to be 6 years. In the third scenario, they are reasonably certain that they will be availing the extendable period for both of the 2 years. In that case, the lease period is going to be 7 years. So this is the explanation of A, that the non-cancelable period plus the extendable period, but extendable period only when they are reasonably certain to exercise that option. That means it is highly likely they will be availing the lease period, extendable lease period. So usually it is a yes or no, whether they will be availing the 2 year extendable period. So it is going to be 7 years. If not, then 5. The second B part, periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the option. Now, that simply means, for example, another 5 year period. And in that case, the lessee has the option that they can terminate the lease after 4 years. They can terminate the lease after 4 years. Now, they do believe that they will not be terminating the lease, then that means 5 years. If they believe that they will be terminating the lease after 4 years, then 4 years. So first of all, the non-cancelable period, and then there will be an addition of the extendable period only if they are reasonably certain. And similarly, periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. So these are the examples of the lease period. We have an example as well. A lease contract is for 5 years with lease payments of 10,000 per annum. The lease contract contains a clause which allows the lessee to extend the lease for a further period of 3 years for the lease payment of $5 per annum, as it is unlikely that the lessor would be able to lease it to another party because they're using for the major part of the asset life. The economic life of the asset is 8 years. The lessee assesses that it is highly likely that the lease extension would be taken. So the non-cancelable period is 5 years, plus there is an extendable period of 3 years, which is a secondary lease period. And they are reasonably certain it is highly likely that they will be availing their option. So the lease period is going to be 8 years, 5 plus 3. So the lease term is therefore 8 years. All right, now we have the accounting for lessee. Now, we have already stated that there are two things to understand within IFRS 16. There should be identified asset and the right to control before classifying a contract as a lease contract. If there's no identified asset, if there's no right to control, then that means it is going to be a contract for service rather than a lease contract. But if the conditions are met, that means there is an identified asset. That means the assets are specifically mentioned within the contract, and the lessee has the right to control. That means right to the economic benefits and right to direct the use of the identified asset. That means now the contract should be classified as a lease contract. And when we say a contract, a lease contract, that means the lessee will be recording the right of use asset. Now that simply means that we have simplified the treatment within the IFRS 16, that in the IS 17, if there was a finance lease, the lessee used to record the leased asset. But now there is no differentiation of the finance and the operating lease. If a contract is a lease contract, then the lessee will be recording the right of use asset. That simply means that the lessee is recording the right of use as an asset. The lessee is recording the right of use as an asset, and credit will be the lease obligations. Now, lease obligations means these are the obligations which the lessee owed to the lessor for the lease period. All the payments which they owe to the lessor. So they will be calculating the present value of it, and then the lease obligation will be credited. So debit entry is the right of use asset. That means we are recording the right of use as an asset, and credit is a lease obligation. Lease obligation is simply the payment the lessee is going to make to the lessor over the lease period. We'll be calculating the present value of all those lease payments. Now, how we are going to measure the lease liability, initial measurement of the lease liability, how we are going to measure that. So the lease liability should be calculated as the present value of the lease payments. The present value of all the lease payments. It includes the fixed payments. Now the fixed payments means the annual lease payments. Fixed payments means the annual lease payments. Variable payments. Now the variable payments means that, for example, if the market rate changes, like somehow you have taken the lease on the variable rates, and if the market rent is changing, then there is some difference between the fixed payment and the market rent that will give rise to the variable payment. So variable payment that depends on an index, for example, CPI or market rent. The third payment will be amount expected to be payable under residual value guarantees. Now this is simply, for example, I have taken an asset on the lease. Let's assume the life of the asset is 20 years. Let's assume the life of the asset is 20 years, and I have taken the asset on the lease of 5 years. Now, after 5 years, I'll be returning the asset to the lessor, and the lessor will be able to lease it to the other parties for the next term as well, next more terms as well. So sometimes the lessor may keep a condition that when you're returning me the asset, it should worth a certain amount. That simply means that you have to take care of the asset. If when you are returning me the asset and that is not worth what we agreed earlier, that means you have not taken care of that asset. And the difference, which will be the amount it should be, and the amount now should be paid by the lessee, and this is known as the residual value guarantees. So amount expected to be payable under residual value guarantees means where a lessee guarantees to the lessor that an asset will be worth a specified amount, and if it is not the case, then the lessee is supposed to make that payment. For example, they told the lessor that the asset, when they're returning, it will worth, let's assume $1,000. Let's assume $100,000, and the worth of the asset is now 80,000. So that means the difference of 20,000, the lessee is supposed to make that payment. Then we have the purchase option. Now, purchase option means that, for example, if the lessor has given the lessee the right to purchase the asset by the end of the lease period, And obviously, they will be making certain payment to buy the asset. And if the lessee is reasonably certain, that means it is highly likely they will be availing that option. So that payment, that purchase option will be considered as well. The termination penalties, for example, if you are terminating the lease before the non-cancelable period or during the non-cancelable period, then you are supposed to make the payment related to termination as well. So these are the outflows. Actually, these are the outflows pertaining to the lease. These are the maximum outflows you may encounter in your exam question over the lease period or regarding the lease period. So the fixed payments, which are the annual lease payments, variable payments, amount expected to be payable under residual value guarantees, purchase options, and the termination penalties. Purchase option only when the lessee is reasonably certain that they will be purchasing the asset by the end of the lease period. They're reasonably certain regarding that. So all of these are known as the outflows. So we'll be taking all the outflows. How are we going to take that? Just a simple format. You take the years, year 1, year 2, year 3. These are the years. And it can be 4 or 5, anything. Then the cash flows, and then the discount factor. Now the discount factor is calculated through discount rate, and this discount rate will be given in the exam. It is either written as the implicit rate or incremental borrowing rate. Whatever it is, implicit rate or the incremental borrowing rate, the rate will be mentioned within the exam. So then you will be able to calculate the present value, and the total of that is the present value of lease payments, which should be recorded as the credit entry here, the lease obligations. So the credit entry is the lease obligation, which you're supposed to calculate by calculating the present value of all the cash flows within the lease period, the cash outflows. Now we have the discussion regarding the debit entry, which is debiting the right of use asset. Now, at what value you are going to debit the right of use asset? So the right of use asset is initially recorded at cost. Now, the same principle we are going to apply as we have discussed in IAS 16. The first thing is going to be the present value of the lease payment, which you have calculated in the last slide. So these are the present value of the lease payment. The first thing should be the present value of the lease payment. This will become part of the cost because the payments you are making for the lease is actually the direct payment and should be part of the cost of the asset. Similarly, the lease payments made or before the commencement date, that simply means the down payments, the advance payment, that will form the part of the cost as well. Then the initial direct cost, and we know any directly attributable cost to bring the asset in the working condition. And then the dismantling cost, if you have any obligation to dismantle the asset by the end of the lease period, then you are going to take that cost as well. So all calculated together will give rise to the right of use asset. So the amount of the initial measurement of the liability, that means the present value of the lease payments plus the, so this is, let me just write it so that you may write a formula with yourself. This is the present value of the lease payments. LP means the lease payments. This is the advance payment, or you can also say the down payment, upfront payment, initial direct cost, any direct cost to bring the asset in the working condition. And then we have this, the dismantling, decommissioning, if you have any obligation to dismantle the asset by the end of the lease period. When all of these are summed, then you will get the right of use asset. So we have calculated the initial value of the right of use asset, and we have also calculated the initial value of the lease obligations. Now let's do an example in order to grip this concept. On 1st January 20X1, Dynamic entered into a 2-year lease for a lorry. The contract contains an option to extend the lease term for a further year. Dynamic believes that it is reasonably certain to exercise this option. Lorries have a useful economic life of 10 years. Now, the non-cancelable period is 2 years, and there is an option within the contract to extend the lease for a further year. And they are reasonably certain that they will be exercising that option. So the lease period is going to be, lease term is going to be 2 plus 1 is equal to 3. The lease payments are 10,000 per year for the initial term. That means for the first 2 years, and the 15,000 per year for the optional period. That means for the third period. These are the obligations, lease payments. All payments are due at the end of the year. When you're making payment at the end of the year, these are known as the payment in arrears. To obtain the lease, Dynamic incurs initial direct cost of 3,000, which is going to be the part of the right of use. The lessor immediately reimburses 1,000 of these costs. That means you're going to take the net. 3,000 is what you paid for the direct cost. 1,000 you got it back, which was refundable. So that means you are not going to make this part of the asset cost. So the net figure of the 2,000 should be made part of the cost of the asset. The interest rate within the lease is not readily determinable. Dynamic incremental rate of borrowing is 5%. I told you it is going to be either the implicit rate of return or the incremental borrowing rate, whatever we are concerned with the percentage. And this percentage has been given in order to calculate the present value of the lease payments. So how we can do that? Hopefully remember the formula. First of all, take the years, year 1, 2, 3. Here we have 3 years. In the first year, we have an outflow of $10,000. In the second year, we have an outflow of $10,000. In the third year, we have an outflow of $15,000. Now we have to take the discount factor. Interest rate is given. You know the formula because we have done that thing previously as well when we were doing the IAS 16. So 1 plus R is 0.5, which is 5% in decimals, raised to power minus 1. In the second year, it is going to be 1 plus 0.05 raised to power minus 2. In the third year, it is going to be 1 plus 0.5 raised to power minus 3. And then you will get the present value of the lease payment, which is the initial value of the lease obligations. I've already done it over here, so there's no need to calculate it. 31,552 is the present value of the lease payment, which is the initial value of the lease obligation. So the double entry would be debit right of use asset, credit lease obligations. And then there was a payment of 3,000 for the direct cost. This should be made part of the right of use. So debit right of use 3,000, credit cash 3,000. 1,000 was reimbursed. So cash debit and the right of use credit, because you're not going to make this payment part of the cost of the asset because this was refunded. This was reimbursed. So the collective double entry would be debit right of use asset by 33,552, because 31,552 is the initial value of the obligation plus 2,000. So 33,552. Credit cash, which is the payment of 2,000 you have made against the direct cost. Credit lease obligations, which is the initial value of the liability by 31,552. So this is how you are going to record the initial value of the right of use and the lease obligations. And now we have the subsequent measurement of the liability, because obviously we are not going to keep this amount on 31,552. We are going to change it further. And that when we are changing it further, this is known as the subsequent measurement. Now, the common sense thing to understand how we are going to change our liability is simply that within the lease, the finance cost is involved. The interest rate is involved. Within the lease, the interest is involved. And there's an interest rate to calculate the interest payment. So when the interest gets due and when the interest is accrued, this interest should be recorded as an expense within the profit or loss. And this will increase the liability. When the interest is being accrued, then it will increase your liability. When the payment is being made, the debit goes to the liability, because when you're making payment, the liability is decreased and credit goes to the cash. So the simple treatment is that the interest that is accrued over the lease payment will increase the liability. So you should record that thing as an expense, debit finance cost, and credit lease liability. Lease liability will increase when the interest is being accrued. When the payment is being made, the liability will be decreased and cash will be credited. So these are the two double entries. And now I can show you this thing in the form of the statement. You take the opening balance. This opening balance, remember, is the present value of lease payments. Either it is given in the exam directly in some questions, or you are supposed to calculate it. When you are supposed to calculate it, you will be simply doing this calculation. The good news will be that it is given in the exam. So if it is given in the exam, you directly take the opening balance. This is the present value of the lease payment. And then you're going to apply the interest on the opening balance. Take the opening balance, multiply by the percentage of the interest, which is again mentioned within the question. When you understand the format, this statement, when you understand the format working, this is going to be just the maths you are doing within the exam. So take the opening balance, either it is given or you are supposed to calculate it. Opening balance is the present value of the lease payment. Then the interest will be applied to the opening balance of the liability. And this will be added because when the interest is accrued, it will increase your liability. And this interest is recorded as the finance cost in the profit or loss. Then you deduct the fixed lease payment. These are the annual payments, which is again mentioned within the question. Deduct the annual payments. And then you get the closing balance. This is the closing balance of the liability. Now, how we are going to record this closing balance? This closing balance is nothing. This closing balance, it is not even the current liability. It is not even the non-current liability. Now, how come is that? The thing is that when you enter into a lease, for example, a 5-year lease, you are supposed to make the principal payment as well as the interest. So when you are making the payment which you are supposed to make within 12 months should be recorded as the current liability. The payment which is outside 12 months should be recorded as the non-current liability. So in order to split the liability between current and non-current, we are supposed to do an extra working for a year. Let's assume in the exam question, they're asking you regarding X6, for example, then you are supposed to do the working of X7 as well. Extra working. Remember this thing. Extra working in order to split the liability between current and non-current. Because the payment we are supposed to make within 12 months is your current liability. Now said that is your non-current liability. So the closing balance of the next year, which is the extra working, is your non-current liability. The closing balance of the next year is your non-current liability. And the difference of two closing balances is your current liability. So this closing balance is nothing. The first year, the year which you are asked for, the closing balance is nothing. You're supposed to calculate the closing balance of another year in order to split the liability between current and non-current. So the closing balance of the next year is going to be a non-current liability, and the difference between these two closing balances is your current liability. So there are three figures which will be coming out of this working. The first figure is the finance cost, and this is for the same year, should be recorded as an expense in the profit or loss. Then we have the non-current liability, which is the closing balance of the next year, the extra working. And then we have the current liability, which is the difference between these two closing balances. So from this working, there will be extracts of both the profit or loss and the financial position. In the financial position, when we are discussing the liability, in the financial position, there is going to be a non-current liability and the current liability. Within the statement of profit or loss, we will be having the finance cost. Now, this working is in arrears. That simply means when you are making the payment at the end of the year. This format will be applied when you are making the payment at the end of the year. Let's do an example. Z entered into a 5-year lease agreement on 1st November 20x2, paying 10,975 per annum, commencing on 31st October 20x3. Now, in the exam, they're not going to use the term they're making payment in arrears, they're making payment in advance. You are supposed to get it yourself by just looking at the dates. See, they are entering into the lease agreement on 1st November 20x2. And they will be making annual payments of 10,975 commencing on 31st October 20x3, which is right after a year. So this difference means they are making payment in arrears. So Z entered into a 5-year lease agreement on 1st November, and they are making payment at the end of the year. So that means this is the lease payment in arrears. All right. The present value of the lease payment was 45,000. And the interest rate implicit is 7%. So we got the present value. There is no need to calculate it. Just put that figure into the format. Then we apply the interest on the opening balance, which is 45,000 multiplied by 7%. It gives you 3150. And this is your finance cost. You deduct the fixed lease payment, which is the annual payment being mentioned over here. And then we get the closing balance. This closing balance will become the opening balance of the next year. Again, simply 37175 multiplied by 7%. You get 2602. Now this 2602 is the finance cost of the next year, not this year. You deduct the annual payments and then you get the closing balance. This 28,000 is your non-current liability, and the difference between these two, which is 37,175 minus 28,802 is 8,373 is your current liability. So this is how you're going to deal with the payment in arrears, and this is how you're going to subsequently measure your obligation. Now we have the payment in advance thing. Now, before understanding the working, let me give you an example. So let's assume you took a 1 million loan from the bank. You took a 1 million loan from the bank and you immediately paid back 0.2 million from it on the same day. You took 1 million from the bank. You paid 0.2 million straight away. Now the interest is going to be applied on 0.8 million because there was no obligation other than 0.8 million throughout the year because you immediately paid back 0.2 million. So similarly, when you're making payment in advance, now again, how you're going to get it, that whether the payment is making in arrears or in advance, you need to see the dates. If when you're entering into a lease and you're making the payment on the same date, that simply means you're making payment in advance. So you take the opening balance, which is again the present value of the lease payments, and then you deduct the payment from it. This is the annual payment. Then you get the subtotal. Now this interest should be applied on the subtotal because you cannot apply the interest on the annual payments because that was paid in advance. You get the closing balance. This closing balance will be the opening balance of the next year. Then again deducting the payment, and then you get the subtotal. Then again subtotal will be used for applying the interest, which will be the interest of the next year. So this subtotal of the next year when we are doing extra working. So let's assume in the exam, they're asking you regarding X6, you're supposed to make the calculation of X7 as well. The subtotal represents your non-current liability. And the difference between these two balances represent the current liability. And this is the finance cost. So the subtotal of the next year is the non-current liability. The difference between the closing balance of the year minus subtotal is the non-current liability. And then you have the finance cost. Okay, we have an example. On 1st January 20X3, Rabbit acquires a new machine with an estimated useful life of 6 years under the following agreement. An initial payment of 13,760 will be payable immediately. 5 further annual payments of 20,000 will be due commencing on 1st January 20X3. Initial payment means the advance payment, and they will be making annual payment of 20,000. This is the annual payment. Don't confuse this 13,760 as annual payment. This is the initial payment means advance payment. The further payment of 20,000. This is the annual payment per year. Commencing on 1st January, that means they're making payment on the same date. So that means this is the payment in advance. Interest rate is 8%. Present value of the obligation is 86,240. So you take the opening balance as 86,240, which is the present value of lease payments. Then you deduct the payment from it because this is payment in advance. Then you get the subtotal. So interest will be applied on the subtotal. And then you get the closing balance. They're asking us to prepare the extracts of 20X4. So this is the relevant year. And this is the extra working. So this closing balance of 20X3 becomes the opening balance of 20X4. Then again, deducting 20,000 from it, you get this balance. Then multiplying interest on the subtotal, we get 4123. This should be recorded as the finance cost in the profit or loss. Then you get the closing balance, which becomes the opening balance of the next year. Then again, deducting the payment, the subtotal represents your non-current liability. And the difference between these two payments represent your current liability. Now we have the subsequent measurement of the right of use asset. So what you are going to do is you are going to depreciate the right of use asset. Now, for depreciation, you need the denominator. You need the number of years on which you're going to depreciate the right of use asset. So right of use asset is measured using the cost model, which is the cost minus its depreciation minus impairment. So for depreciation, we have two important points. If the ownership of the asset transfers to the lessee at the end of the lease term, then depreciation should be charged over the asset's remaining useful economic life. Now, for example, the lease period is 5 years. This is the lease period. And the economic life is 7 years. Lease period is 5 years. Economic life is 7 years. And it states that the ownership of the asset will be transferred to the lessee by the end of the lease period. That means now the lessee will be using the asset 7 years instead of 5 years, because after 5 years, the lessee will have the asset and they will use for another 2 years. In that case, the depreciation should be charged on 7. Otherwise, it should be charged at lower of. Now, lower of what? The lower of lease period, lease term, and the useful life. So in the example we took, the lease period is 5 and 7. So the lower would be 5. So if the asset will be transferred to the lessee, then we take the economic life rather than the lease term. And if that is not the case, then we take the lower of because in that case, you have to return the asset after the lease period. Okay, now we have the separating components. Now, separating components means sometimes when you are entering into a lease contract, within the contract, there can be two components, a lease component and a non-lease component. For example, you're giving a machine on the lease and you're providing services as well. Now, obviously, these services are not lease component. The machine you are providing, which is an identified asset, qualifies the criteria of the lease. But the service you are providing alongside the machine is not the lease component. It's a non-lease component. So if that is the case, then you are going to split it between the lease and non-lease, and accordingly, the accounting should be done. We have an example just to understand the concept. On 1st January 20X1, Swish entered into a contract to lease a crane for 3 years. The lessor agrees to maintain the crane during the 3-year period. The total contract cost is 1,80,000. Swish must pay 60,000 each year, with the payments commencing on 31st December. That means when you are making payment at the end of the year, this is lease payment in arrears. Swish accounts for lease and non-lease components separately. If contracted separately, it has been determined that the standalone price for the lease of the crane is 160 and the standalone price for the maintenance service is 40. That means they are giving a discounted amount. So when you total these two, the standalone price is 160 and 40, it is 200. So there's a discount involved within this transaction. Swish can borrow at a rate of 5%. Explain how this should be accounted. So you need to separate. How we can separate it? Again, we know the formula. We have already done it in the IFRS 15 when we were applying the discount to the different performance obligations within the contract. So the 160 divide by 200 multiply by 60. 40 divide by 200 multiply by 60. So 48,000 is the price of the crane and 12,000 is being allocated to the services. So 48,000 every year is the lease component. So you take 48, 48, 48. These are the 3 lease payments because this 12,000 is a non-lease component that will be expensed to the profit or loss. You get the present value, which is 137.15. This is the initial value of the lease payment. So you're going to debit the right of use and credit lease liability. Then this value will be placed in the format in order to calculate the subsequent value of the lease obligation. So interest would be applied on the opening balance, less the fixed lease payments, and then you get the closing balance. So with the finance cost, lease liability will be increased. With the payments, lease liability will be decreased. And then you have reassessing the lease liability. Because I told you sometimes you have taken the lease on the variable rates. Sometimes it may possible that those payments are changing. The liability will change as well. So if the changes to lease payment occurs, then the lease liability must be recalculated and the corresponding figure will be posted to the right of use asset as well. IFRS 16 says that the liability should be recalculated using the revised discount rate if the lease term changes and the entity's assessment of an option to purchase the underlying asset changes. Like for example, initially we recognized that we are not going to purchase the asset, and later on we decided to purchase an asset. So that means another outflow will be part of the lease payment as well. So if that is the case, then you are going to revise your lease liability. Then we have another important thing within IFRS 16, which is the short-term leases, which is 12 months or less. So if you have a short-term lease, which is 12 months or less, then there's no need to capitalize that component as the right of use asset. What you can do, instead record that short-term lease in the profit or loss on the straight line basis. So the short-term lease can be expensed out within the profit or loss on straight line basis. And there's no need to record the right of use and the corresponding liability. Similarly, we have the low value leases. For example, you are leasing tablets, personal computers, telephones, small items of furniture. There's no benchmark, although for the low value leases, but you can say the guide is which is less than $5,000. So in that case, there's no need to create that thing as a right of use. You can simply expense that out in the profit or loss on the straight line basis. And remember, the car does not qualify the low value asset criteria. On 1st April 2006, Taggart acquires telephones. Now we know telephones are the low value leases. Taggart acquires telephone for its sales force under a 2-year lease agreement. So it's not a short-term lease, it's a low value lease. The term of the lease required an initial payment of $2,000, followed by 2 payments of $8,000 each. So it is very important to understand the question properly. Followed by, that means further 2 payments of $8,000 each. That means 2 payments of $8,000. So that simply means 8 and 8, 16 plus 2, 18. 18,000 is the total amount you're paying for 2 years. So per year lease payment is 9,000. This is 9,000 per year. Show the impact of this lease arrangement on the financial statements of Taggart for the year ended 31st December 2006. So they entered into the lease on 1st April, and they're asking the extracts of 31st December. So that simply means you're going to take 9 months. So what you're going to do, take 9,000, divide by 12, multiply by 9. So when you divide 9,000, divide by 12, multiply by 9, you get 6,750. This is the expense for the year ended 31st December 2006. Now you have only paid 2,000 from this. The rest is the accrued expense, which is the expense that belongs to the current year but not yet paid. So the double entry would be debit expense. That simply means debit profit or loss by 6,750. Credit cash, which is the payment you have made, only 2,000. And credit accrued expense, which is your liability, 4,750. All right, now you have the mid-year entry into a lease. So it's something very easy to understand. If a company enters into a lease partway through the year, the depreciation interest will need to be time apportioned. For example, you're entering 6 months, exactly halfway through the year, then the interest you will be taking, whatever it is. So you take the opening balance, multiply by the percentage, multiply by the months by 12. Similarly, when you're talking about the depreciation, you take the right of use, divide by the lease term or life, and then you get the per year depreciation, multiply by months by 12. So whether it is interest payment or you have the depreciation. So when you're entering into a lease mid-year, it's not exactly mid-year. It can be anything, 3 months, 6 months, 9 months, whatever it is. So you need to prorata it by multiplying it by months by 12.